Sylvia Amaro. We're counting down to the latest rate decision from the European Central Bank, which is expected to cut rates by 25 basis points today, taking the benchmark rate to 3%. This following rate cuts at 3 of the central bank's last 4 meetings, with November's flash harmonized inflation figure at 2.3%. Let's get a check on how we're moving at this stage ahead of that rate decision, starting with the FX space. Euro-dollar, we have seen the euro just slightly higher against the US dollar earlier this morning. As we approach that rate decision, we are now seeing a bit of a change in sentiment, with the euro just marginally trading lower against the US dollar, below that 1.05 that we had seen earlier today. I also want to take you to the bond market and understand how 10-year yields are moving at this stage. What do we have? Well, we have the yields moving higher at this stage ahead of that rate decision. I just want to take a look at the benchmark rate. The yield on the 10-year bond at this moment trading at 2.14. Let's see what will happen once we get more clarity from the European Central Bank today, not just in terms of the rate decision, but of course, what is the outlook here? Because they will also be publishing new economic forecasts. Let's also get a check on the equity space and understand how we are moving across European bourses. It is a bit of a mixed picture at this stage. We're lacking strong conviction so far, except over in Italy, where we have the FTSE MIB up almost 0.5%. And of course, Annette is joining us this morning from Frankfurt with more. Annette, you are there monitoring what the ECB is going to say later today. Earlier this morning, of course, we talked about how they're likely to cut rates by 25 basis points, but I would like to focus now on the economic outlook here. What are the projections expected to say to us when we are looking at economic data, whether that's PMI, GDP, and so on, all of them signaling that the Eurozone economic outlook is not the rosiest at this stage?
Yes, exactly. That's what we are probably also hearing from the ECB. But we are going to get the new round of staff projection. This time around, it will be conducted by the national central banks. They have a tendency to be a little bit more pessimistic than when it is done by the Eurosystem staff here in-house. So I guess what is very likely is that we are going to get a downward revision of GDP growth for the next 2 years, and then we'll get a new figure for 2027. That's the first time we're going to hear anything about this year, like 3 years away. And of course, the inflation figure might also see some downward revision for next year, given that we are already seeing inflation below what the ECB thought it to be at the end of this year. So it's a bit of a complicated mix. Of course, the uncertainties weighing on the inflation outlook are paramount, with the looming tariff imposed by the Trump administration and a potential response from the European side as well that could have reinflationary effects, at least in the medium term. and the short term, most likely not, only perhaps an anticipation. What will weigh against this is that wage pressure will abate probably quicker than previously expected. We are seeing in the biggest economy of the euro area, in Germany, massive rounds of layoffs, at least announced in the manufacturing space. And the car sector, of course, is the biggest negative example here, but also all the suppliers and companies who are dependent on the car producers are having the same problem. So having said that, there will be less wage pressure, by that also less inflation pressure. And I guess the ECB will try to balance those two potential developments when they gauge the future inflation development. So that's what we're going to get from the economic picture. And I guess the big question is, how will that translate into monetary policy rate decision going forward? A lot of market people are suggesting that the next move should be a 50 basis point move, because we've seen that from the Swiss National Bank. But I think the ECB will not follow suit so easily, because it's a different central bank. It's much more complex. There are hawks and there are doves, whereas the camp of the hawks is actually getting smaller and smaller as the economic picture is getting unrosier by the moment, or by as we speak. So I guess this will be the big question mark, whether they will say anything about the future rate path, whether they will say anything about what they think will be the terminal rate.
I guess not long now until we find out, Annette. We'll let you get ready for that rate decision. In the meantime, let's discuss the outlook here with Danielle Lagarde, the chief economist at Tressis. Danielle, good to see you once again. You know, markets are expecting a 25 basis point cut, but as my colleague was highlighting there, it is also likely that the central bank is going to have some sort of discussion today about a 50 basis point cut. Even though that might not end up being the case today, it might be something that they choose to do further down the path. What do you think is likely to happen here? Are we looking at an economic picture that warrants a 50 basis point cut at the start of 2025?
Hi, Sylvia. Absolutely, we are. And I think that with the likely downgrade of estimates from the ECB in this meeting, it is quite significant that we are going to see a very different path compared with the United States. The euro area is certainly reducing its inflation rate, its annual inflation rate. However, it's coming from stagnation of the economy. And if the downgrades are significant, which could be, particularly considering the challenges in France and Germany, then it is pretty obvious that the European Central Bank needs to think more about credit growth, and there could be a stronger action in the next meeting. I think that this one is pretty obvious that they're going to be quite data dependent, but I think that in the next it's going to be everything about the economic outlook.
So let's discuss that in more detail. In your notes, you said that you don't expect the euro area to enter recession in 2025. But that's not really good news, is it? Avoiding a recession still suggests that we could see very low levels of economic growth. How are you looking at the outlook here, and how concerned are you ultimately about the lack of growth across the continent?
I'm extremely concerned about the lack of growth, because we must remember that it is also happening in the middle of one of the largest stimulus packages ever implemented in the euro area, the Next Generation EU Fund. So with the stimulus package, with a central bank that is being very accommodative, and with fiscal policy being hugely benign still, with all of the limits lifted by the European Commission, all of those factors are not helping at all the European Union and the Eurozone. Our expectations are actually quite optimistic in terms of not expecting any type of recession, but certainly stagnation is the risk. And with the fiscal challenges of France, which are going to be one of the headaches for the European Commission and the ECB in 2025, that is likely to be quite concerning. However, on the positive side, what I think is that the worst of the manufacturing sector and the worst of the consumer are pretty behind us. So I would be at least not certainly optimistic, because it's very worrying to see a European Union that doesn't have technological leadership, that doesn't have industrial leadership, and that continues to have extremely high energy prices. I think that obviously what we can at least expect is that avoiding the recession and getting a little bit of traction on the manufacturing sector may support an ECB that can cut rates without fueling inflation.
So let's discuss that also, because when you think about the economic outlook, we also have to discuss the potential threat of tariffs from the United States. In your notes, you also highlight that you don't expect tariffs to be inflationary. Walk us through that rationale.
Well, the reason why I don't think that tariffs are inflationary is because we have seen it in the past. 2016 to 2021, we had no inflation, and all the tariffs of the Bush, Obama, the Trump administration were maintained, and there was no inflation until 2022, in fact. So I think that what we know is that inflation comes when the tariffs are implemented on products that are produced 100% abroad, outside of the country, and have a completely inelastic demand. And that is very, very rare. However, what tariffs do is impact trade growth and impact bilateral agreements that can help the economy grow faster. Obviously, that is something that is very, very important. But I think that the Trump administration is going to implement the tariffs with a view of negotiating them, particularly with the partners of the European Union. So if the European Union starts to lift some of the trade barriers that are burdening the automotive, agricultural, and farming sector in the United States, then certainly there is plenty of room to negotiate. So I'm less negative about tariffs in general. I'm more worried that the European Union decides to act if there is an announcement of tariffs with more tariffs, and that there starts a trade war.
Well, let's see what will happen when we have Donald Trump at the White House. We appreciate your time this morning. Daniel Lagarde, chief economist at Addresses. We're now just minutes away from that all-important announcement from the ECB. We'll bring you the decision after this break. We are now just minutes away from the ECB's latest rate decision. So let's get a check on how euro and US dollar are faring at this moment. We have the euro marginally lower against the US dollar at 1.048. We are seeing lower levels for the euro compared to what we had earlier today. We were actually trading at 1.05, so a little bit of cautious approach among investors as we await the rate decision from the European Central Bank. Also worth keeping in mind that it's not just about that rate decision, it's also about the outlook. What will be the numbers in terms of GDP and inflation that the ECB will provide us with today? For that, let me just share this context with you. We had the latest inflation print for the Eurozone in the month of November, rising to 2.3%. Let's see what will end up being the outlook from the ECB going forward. We have seen a little bit of an uptick here in terms of inflation figures, something that the ECB had actually highlighted and had forecast in the past. But what is the trajectory going forward, particularly when we are seeing lower economic growth, the threat of sanctions as well from sanctions on tariffs from the US as well? We are just seconds away from that rate decision. We have, just for some context here, the ECB's deposit rate is the one that we monitor closely. The deposit rate was at 3.25%, and it has now been cut by 25 basis points, bringing it to 3%. So no surprise from the ECB today, going ahead with that 25 basis point cut, as investors had priced then. So no surprise there. Let's see how investors will be reacting to this. It's also worth keeping in mind, as I suggested to you earlier, that it's the numbers in terms of economic growth and inflation that will matter today. So let me share them with you. The new inflation forecast for this year came in at 2.4%. So that's the number for 2024. The ECB expects the inflation to then come down to 2.1% in 2025. 1.9% in 2026 and 2.1% in 2027. Today is the first time, it is the first economic forecast that we have from the ECB that includes numbers for 2027. And this is important because when you think about what we are looking at the moment, we see the ECB expecting a little bit of an uptick in terms of inflation between 2026 and 2027. I also want to share with you what else the ECB is telling us this morning. There's, of course, a lot of comment coming through. We know this is a tricky time for the central bank because the uncertainty going forward is huge. The ECB is saying, however, it will follow a data-dependent and meeting-by-meeting approach to determining the appropriate level of monetary policy. No change there as well in terms of their approach to how these decisions are being made. Data-dependent, meeting-by-meeting. So if for those investors out there that were wondering whether we're going to get some sort of forward-looking guidance today, that does not seem the case. Let's see what Christine Lagarde is going to tell us during the press conference. And just a final comment as well in terms of what the ECB is sharing with us today. They are saying that they are not pre-committing to a particular rate path. And we know that investors are wondering what is the level of the neutral rate going forward. So let's see whether we'll get a little bit more of clarity from the ECB when we get the press conference. For now, though, I want to return to our correspondent in Frankfurt. Annette, no surprise from the ECB today, a 25 basis point cut. This is what we expected. This is what we're going to get. But how are you reading their messaging in terms of the economic outlook?
Well, the economic outlook is obviously downgraded. That was pretty much expected from the ECB. The ECB is still on average quite optimistic for the economic development of the euro area as such, given that the two biggest economies are literally no growth economies, and also the outlook for growth is quite uncertain because they also can't expand fiscally any much more. So we can't replicate what the United States is doing, and I guess this is sort of a European homemade problem in a way, because fiscal spending will be reduced during the course of 2025, and that is most likely one of the reasons as well why we see that lackluster growth in the euro area, with 1.1% in 2025, 1.4% in 2026. It's an average growth rate, so that we have to keep in mind that like higher growing economies like the Baltics, for example, and even Spain are included in that average. That means that others are barely growing. I think what one should highlight is as well that they're saying that domestic inflation, that is the part of inflation they are focusing on with a special focus, is easing, and that's positive. They're still saying that domestic inflation has edged down but remains high, mostly because wages and prices in certain sectors are still adjusting to the past inflation surge. But the positive message here, it's on the downward trajectory, and I think that gives them more room and ammunition to actually cut rates more forcefully, given that the economy seems to be not going as well as previously expected, even though they're saying they saw a slight pickup in economic activity in the third quarter. Financing conditions, we should mention that as well. They are easing, so they are still restrictive, but they continue to be tight, they say, and that is as well a sentence which one should concentrate on when thinking about the future rate outlook, because clearly if they think it's still tight, then they can loosen it up much more, even though they are saying that past rate hikes are still transmitting through the system. So currently we have like a dual process. At one point, at one side, the rate cutting cycle has already a slight effect on financing conditions, but at the same time, the past rate hikes are still working itself through the system. So it is both tendencies at the same time. That's what the ECB is saying. But they're saying it's still restrictive, and so I guess this gives them, or that will make the market believe that they keep on cutting until they find their new equilibrium, wherever that is, because the ECB doesn't want to give away what they think is the neutral rate for the euro area. It's just a speculation by economists that it could sit between 1.5% and 2% right now. So in a nutshell, I think during the press conference all that might be of interest, and also the key question is whether they have discussed the 50 basis points rate cut or not, or whether they have kept that for the future, meaning next year, and how concerned they are about the state of the manufacturing industry, layoffs, and whether this means much less wage pressure going forward. So I guess we are in a bit of a, as I said, again, uncertain environment, but still the ECB will keep on cutting rates. They still see restrictive financing conditions, and they see that the economy is not doing as well as they projected it to do back in September of this year.
Well, no doubt there will be a lot of questions for Christine Lagarde, and we also let you get ready for that press conference in just a couple of minutes' time. I want to get a check on how markets have been reacting to this decision from the ECB. Of course, it's still early minutes since we got that decision, but the euro has fallen to a 9-day low. We see further pressure on the euro in the aftermath of this rate decision, but perhaps with investors even more focused on the fact that the ECB is downgrading some of the forecasts for next year, and we know that there's a lot of pressures really on the outlook. So there will be further pressure as a result, also from investors on the central bank perhaps to do more next year. Let's also get a check on what's been happening in the bond market. Here, however, we haven't seen huge changes in terms of positioning. Let's just get a check on the benchmark, the yield on the 10-year bond at this stage trading a little higher, 2.14%. No moves over in France for now. We don't get a reading at the moment, but let's see what will happen there. Because, of course, with the instability in France, no doubt that this is also an important moment to look at the French paper. Let's discuss this in more detail with Joe Tuckey, head of FX analysis at Argentex. Good morning, Joe. Good to have you here. Good afternoon, I should say. I've been here for a couple of hours now. I just would like to understand how you're reading this move in the FX space, because we are seeing further pressure on the euro. Yeah. A lot of people starting to wonder whether we're going to reach parity at the start of a new year. How are you reading it, and what is the outlook?
Do you know, in isolation today, quite a minimal reaction in euro dollar. For me, the damage was done on the move from 112 down to sort of where we are now at 105. Back in September, when we saw those awful PMI figures, which prompted that October sort of surprise rate cut from the ECB. So, you know, the euro's been very weak the last few months. It's priced in a lot along the way. So for us to deliver, you know, an as expected outcome from the ECB today, you know, we're seeing a sort of commensurate reaction in the euro with just a 20-30 pip reaction in euro dollar. I think it's a pretty benign outcome, really.
But if we get any sort of detail during the press conference around the discussion within the central bank about whether they should have done a 50 basis point cut, how would you interpret that?
Yeah, look, I think there's various different views within the ECB. Obviously, we've got the sort of hawks out of Germany, Schnabel and Nagel and so on. I think they're of the view that there's structural problems in the Eurozone, and perhaps the efficacy of cutting rates further is not going to be particularly great. And then perhaps within you know, Panetta out of Italy, for example, is very much advocating let's cut rates aggressively, let's go hard and fast over the next 6 months to really to really stimulate things. So it seems to be at the moment that there's that sort of middle ground compromise is winning the day. For sure, Lagarde is going to have to talk about tariffs. She's going to have to talk about the issues in France and Germany politically, because obviously that's going to continue to weigh on sentiment going forward.
And then when it comes to France, we know obviously that she's quite, well into the subject, having been a finance minister for France as well. I would like to understand here what would be the development, the event that could actually tip the hawks to say, okay, let's go for a 50 basis point cut in 2025 at the start of the year.
I think, as I said earlier, that PMI development back in the autumn, I mean, we have PMI data coming out of the Eurozone next Monday, for example. That was the real trigger for this more aggressive downside move in euro, and of course, for the market to start pricing in a more dovish expectation out of the ECB. So I think things like PMI data starting to deteriorate, that's going to have to get those hawks leaning a bit more dovish. There's not a lot of good news out of the Eurozone at the moment, these structural issues intra-Germany and so on. And then, of course, if these punitive tariffs are on the more punitive end from Trump, of course, that really we'll learn more in the first part of his second term as to quite the extent of these tariffs. And if they are as punitive as he's threatening, I think that's going to be a trigger for those hawks to finally give in.
So let's talk about the outlook here, because when you think about what just highlighted there with the arrival of Donald Trump once again at the White House, and when you think about the lack of detail from the ECB in terms of what they're going to do in the new year, what I would just like to understand here is how are you reading the lack of synchronization between the Fed and the ECB in terms of the outlook for the currencies? There's different speeds between the ECB and the Fed.
But for so long this year, we've had synchronized, first half of this year, there was very little volatility in FX markets because essentially the central banks were all doing the same thing. Once again, we're seeing a little bit of divergence, obviously, between the Fed, the Bank of England and the ECB. The ECB is the less exciting one. It has been all year. They keep their powder dry. They're very much data dependent, meeting by meeting. We've sort of seen that again today, haven't we? Whereas I feel like we're getting a little bit more guidance from some of the other key central banks, and I think they're going to be left with very little choice essentially into perhaps Q2 next year, where we'll see more aggressive guidance perhaps and more aggressive policy action.
Well, let's see. That would be an exciting, a new phase really for monetary policy compared to what we have had. I just would like to understand finally the expectations as well, because obviously it's December, so it's always important to understand what might come in the future. At the end of last year, the expectations for monetary policy were totally off compared to what ended up happening this year, right?
Yeah, absolutely.
Yeah, we were totally off. So when you think about 2025, have we learned any lessons over the last 12 months that could give us a little bit more, clarity about what to expect from central banks?
We've probably learned that people that try and forecast monetary policy can get it very, very wrong. I mean, I'll recall at the beginning of this year, we expected a 25 basis point cut from every meeting from the Fed, for example.
Exactly.
That turned out to not be the case. I feel like we're able to get a slightly better grasp on what central banks are likely to do next year. But look, events happen, things change, and for sure, forecasters can be very wrong when it comes to trying to predict rate policy.
I guess that will mean they will also be very busy. So we'll see what the expectations will be and what will end up happening. That was Joe Tuckey, head of FX analysis at Argentex. Thank you for your time today. Now stay tuned. We'll have more reaction to the ECB's latest decision after the break. And of course, we'll bring you Christine Lagarde's press conference as well, live at 14:45 CET. welcome back to Decision Time. I'm Sylvia Amaro. Time now to recap what we've heard from the ECB thus far. The main announcement has been a cut of 25 basis points to the deposit rate, bringing it to 3%. This is actually a level that, if we take a look at the historic performance of monetary policy, this is a level that we had not seen since March 2023. That was the last time that we saw the deposit rate at 3%. Now, in terms of other announcements from the ECB that are also important for the markets, we saw the ECB cutting its growth forecasts again, and indeed seeing inflation settling at 2%. So the dynamic on the inflation front seems to be getting a little bit more on track with what the ECB wants to achieve. However, those growth concerns have reached Frankfurt at this stage. We had negative data when you think about PMIs. All of the economic data recently has indeed pointed to the lack of growth really across the bloc, whether you look at France, whether you look at Germany. And that is also clear now in terms of what the ECB is forecasting itself. So just to give you an idea, the GDP figures for the Eurozone are seen expanding 0.7% this year, 1.1% next year, and 1.4% in 2026. These figures were all revised down from the previous round of projections seen 3 months ago. So let's get a check on how investors have been reacting to this news. Thinking about the FX space, euro dollar, we continue to see weakness on the euro against the greenback at this stage, trading at 1.048. We were at 1.05 earlier today, so weakness now continuing for the euro against the US dollar. When you think about what's been happening in the bond market, this is how we're moving in terms of European yields. I always enjoy looking at the benchmark. That gives us a better indication, really, of how investors are reacting. You have the benchmark, the yield on the 10-year bond higher at 2.13%. We continue to see, however, different moves over in France with downward pressure for the yield on the 10-year OAT. This is likely to be another topic of conversation when we start hearing from Christine Lagarde during the press conference. No doubt that journalists will have questions about the political uncertainty in France and what that will mean as well for the fiscal position of Europe's second largest economy. In terms of how we're moving in the equity space, this is it. Looking at the main bourses across the European continent, we have pockets of green across the board, but more pronounced moves over in Italy with the FTSE MIB up almost 0.5%. But I want to take it to Germany. The extra DAX also marginally higher at the moment. But indeed, when you think about all of the negative news that we have heard from the corporate front in Germany, at this moment, however, after the ECB rate decision, we are seeing a little bit of pockets of green for the German stock market. I want to discuss European banks too, because no doubt this is a sector that it is rate sensitive. And this is how investors are reacting to the news of changes in interest rates from the ECB. It's worth keeping in mind, though, that we are not looking at significant moves in the banking space, because the decision to cut rates by 25 basis points was very much priced in at this stage. So, however, and we know that there's also corporate dynamics to keep in mind. When you think about the BNP Paribas at this stage down 0.5%, Commerzbank up almost 1%, and Banco Santander over in Spain also up about 1.2%. Now let's discuss everything that we have heard so far with our next guest, Jens Heisenschmidt, Chief European Economist at Morgan Stanley. Good to have you on the show. I just would like to understand first and foremost, what is the outlook here for the currency? I was discussing it with our previous guest too, but always interesting to get different points of opinion here. We see a weakness on the euro at this stage. What are you pricing in for 2025?
Yeah, hello. Thank you for having me. And indeed, we see a bit more weakness for the euro coming still in our forecast. While at some point we also see then the euro gaining strength. So this is really a question of the time profile here. But I think immediate reaction is what you described. We see here a concentrated focus on, if you sort of look at from the lens or through the lens of markets, that the ECB is very likely to cut further, whereas there are more question marks around what the Fed is going to do.
talk to us about the outlook for rate cuts in 2025 as well. In your latest notes, you did say that you're expecting the ECB to reconfirm a faster pace of rate cuts in 2025. Why? Where will the pressure be coming from?
So I think we saw it already now in the statement. Essentially, what we've got is, as you said before, an expected 25 basis points cut, yes. But we've got also confirmation, yes, inflation is going to be very likely, according to most measures, that's the statement language chosen by the ECB, on target at 2%. Then we have a monetary policy stance that's characterized in the same statement as still restrictive, while the sentence that we had previously still in the statement that rates have to be kept at restrictive level in order to get inflation back to target is cut out. So that essentially translates into, okay, now we get back to neutral. The question is, where is neutral? Now, if you have followed the discussion entertained by governing council members in terms of what their view is, where neutral is, probably you would come out somewhere between 2 and 2.5%. So we are at 3%, more cuts are coming. I think that's essentially also our forecast. We have basically the ECB cutting in January and March, then they would be at 2.5%, and then we have the ECB pausing, sort of taking a breath, seeing how the data comes in, and then just to re-accelerate the rate cutting cycle in June on the back of weak wage data. But that's something that's not yet in that statement. Here, really, the focus is short-term, getting back to neutral.
100%. They're very much reinstating, once again, data-dependent, meeting-by-meeting approach here. I would like to look at the debate over a 50 basis point cut. Also, we know that it's likely that they at least talked a little bit about that possibility today. What I would like to understand from you is the pros and cons for a 50 basis point cut in early 2025, and what could tip really the balance towards a bigger cut at the start of next year.
I mean, that was the big debate we had with investors in our conversations. I think at some point it pretty much then settled on the 25, simply because there was an absence of any clear pounding the table from within the ECB, from the governing council, that the 50 would be merited. But if you sort of look at the fine print, if you think about an ECB that has been cutting today, characterizing rates as being still restrictive, but saying that restrictive rates are no longer needed, you can immediately see where the debate on the 50 is coming from. Now, fast forward to January. Here, the problem is that there is not really a holistic, as we would call it, reassessment of the overall stance through the projections. So it's a bit something that has to come from very weak PMIs and a mix of very weak PMIs, weak details for the November inflation, weak December inflation. They won't have the January inflation, which is very important because of all the resets of contracts available for the meetings. So it's a hard one to think that you could see the 50. In the conversations we have with investors, we typically play this game like, what would make them cut by 50? I have a hard time thinking about that. But, as I said, a very pronounced weakness out of the indicators I just mentioned may tilt the balance. I think a reason why they didn't do it today was also because there is this uncertainty how close to neutral you are really. And you don't really want to front load that discussion. This is going to be an ongoing discussion between council members over the next month. And so you don't want to rein in already by saying, oh, we go to 275 already now. And then we are, by some measures, by some opinions, already at neutral or close to.
So where do you think that level is? The discussion seems to be, getting more and more steam at this stage. Where would you say, how far the ECB from landing on that neutral rate?
Probably still quite some, distance away. We would rather, opine with those or be with those that think it's rather at 2%. And you could even find arguments why it's a little bit lower. I think you did have an inkling of other forces. I think that's in the statement as well, with the 2.1% headline inflation expected for 2027, which is something we didn't expect due to the trading scheme and emissions. Here, I would say there is clearly an sort of hint that more is coming. We are in a new environment, lots of forces that we don't really know how they will play out. Another force that in the past has been discussed often was owner-occupied housing. So that may actually bring up inflation to a different level than we have seen it pre-COVID. And so all of that may suggest we have to be very careful in terms of declaring, oh, we go just simply back to where we have been before. At least that's what I read from that statement.
Well, I'm sure we'll have more opportunities to speak in the future, perhaps understanding also the challenges on the fiscal front. But we appreciate your time today. Jens Eisenschmidt, Chief European Economist at Morgan Stanley. And stay tuned. We'll bring you Christine Lagarde's press conference after this break. Welcome back to Decision Time. We're now awaiting ECB President Christine Lagarde, who is due to deliver her press conference shortly. In the meantime, let me just recap what we have heard so far from the central bank, announcing a 25 basis point cut to the main rate, to the deposit rate, bringing it to 3%. We have not seen that level for a while now, and indeed it is an important moment in the trajectory for the ECB to bring down the level of interest rates. In terms of how markets have been reacting to the news, it was in the FX space that we have seen more of a pronounced reaction so far, with further weakness for the euro. At this stage, you have it on your screen. We have the euro trading at 1.05. We are seeing that weakness actually reversing at this stage. So we were at that 1.05 level earlier today. Then we were below it off the back of the rate decision. And now it seems that we're getting back to that level. Let's see where this is going to settle. Of course, investors are also still waiting to hear from Christine Lagarde. That could tip the balance here on the euro versus the greenback. But nonetheless, it is an important moment because it is also the final rate decision from the ECB this year. And they are providing us with further details on the economic outlook going into 2025, all the way until 2027. This is actually the first meeting where they're providing us with numbers for 2027. And when you think about what they've announced in terms of the forecasts, they've had to cut the forecast in terms of GDP growth for the following year. So for next year, for 2026, and even for 2024, the three readings were brought down. We know that there's a lot of pressure on the Eurozone economy at this stage. Whether you look at France, whether you look at Germany, there's pressures across the board. And it's not that the outlook is looking very rosy either when you think about how fragmented the geopolitical scene is as well, in particular when there's the threat of potential tariffs from the United States also on the Eurozone economy. And we know how closely the trade relationship between these two blocs has been over the years. So Let's see what the announcements from the incoming president could mean also here for the ECB. Let's also get a check on the bond market, see how we're moving there. Here, however, as I highlighted earlier, we haven't seen huge amounts of reaction, but we have to continue paying a close attention to when you think about the spread between the German bond and the French paper, because we're still waiting the details from the French president in terms of who's going to be the next prime minister. And that will be important to understand what sort of fiscal plan this new person is going to have for the country. It is the second largest economy in the Eurozone. And at this stage, we don't know exactly what is the plan in order to bring down the huge amounts of public debt as well as deficit. We were on track to see a 6% deficit for 2024. And when you think about the rules across the Eurozone, they are supposed to have deficits at around 3%. So that's double, really, what we have seen for the French economy. Now, we're waiting to hear from Christine Lagarde. While we await for the press conference, I want to take a quick look also how European lenders are moving. We know that this is actually a rate-sensitive sector. Thinking about the banking space is also an important moment, not just because we are witnessing consolidation across the board, but also the fact that rates are coming down. And that's also important because when you think about the outlook for the economy, well, that's also not providing a lot of positive sentiment for European banks. So BNP Paribas at this stage down 0.5%. Less pronounced moves for Deutsche Bank, just marginally lower. UniCredit at this stage up almost 1%, but UniCredit is a story in itself amid the plans for consolidation across the European Union, with them perhaps seeing a larger stake over Commerzbank and indeed also looking at consolidation in their domestic market. I'm just going to quickly check what's happening over in Frankfurt. We have Christine Lagarde at this stage, just taking a couple of pictures ahead of that press conference. She still needs to be introduced also by her press attaché. Let me also take a look at other parts of the market. We haven't had a chance to look at the real estate stocks. Perhaps we'll do that later on today. But that is also another sector that is quite sensitive to rate announcements. We see how some of those companies could be moving off the back of this. Now, we know going into this press conference, the questions will be about the outlook. Why have you lowered your economic forecasts? And how concerned are you with the fiscal positions over in France and Germany as well? I believe that it's imminent now that we're going to hear from Christine Lagarde. So let's cross over to Frankfurt to hear from the president of the ECB, Christine Lagarde, addressing the journalists over in Frankfurt.
Thank you very much, Wolfgang, and good afternoon, good morning to all of you. The Vice President and I welcome you to our press conference. The Governing Council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. The disinflation process is well on track. Staff see headline inflation averaging 2.4% in 24, 2.1% in 25, 1.9% in 26, and 2.1% in 27 when the expanded EU emissions trading system becomes operational. For inflation excluding energy and food, staff project an average of 2.9% in 24, 2.3% in 25, and 1.9% both in 26 and 27. Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Domestic inflation has edged down but remains high, mostly because wages and prices in certain sectors are still adjusting to the past inflation surge with a substantial delay. Financing conditions are easing as our recent interest rate cuts gradually make new borrowing less expensive for firms and households. But they continue to be tight because our monetary policy remains restrictive and past interest rate hikes are still transmitting to the outstanding stock of credit. Staff now expects a slower economic recovery than in the September projections. Although growth picked up in the third quarter of this year, survey indicators suggest it has slowed in the current quarter. Staff see the economy growing by 0.7% in 24, 1.1% in 25, 1.4% in 26, and 1.3% in 27. The projected recovery rests mainly on rising real incomes, which should allow households to consume more and firms increasing investment. Over time, the gradually fading effects of restrictive monetary policy should support a pickup in domestic demand. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity. The economy grew by 0.4% in the third quarter, exceeding expectations. Growth was driven mainly by an increase in consumption, partly reflecting one-off factors that boosted tourism over the summer, and by firms building up inventories. But the latest information suggests it is losing momentum. Surveys indicate that manufacturing is still contracting and growth in services is slowing. Firms are holding back their investment spending in the face of weak demand and a highly uncertain outlook. Exports are also weak, with some European industries finding it challenging to remain competitive. The labour market remains resilient. Employment grew by 0.2% in the third quarter, again by more than expected. The unemployment rate remained at its historical low of 6.3% in October. Meanwhile, demand for labour continues to weaken. The job vacancy rate declined to 2.5% in the third quarter, 0.8 percentage points below its peak, and surveys also point to fewer jobs being created in the current quarter. The economy should strengthen over time, although more slowly than previously expected. The rise in real wages should strengthen household spending. More affordable credit should boost consumption and investment. Provided trade tensions do not escalate, exports should support the recovery as global demand rises. Fiscal and structural policies should make the economy more productive, competitive, and resilient. It is crucial to swiftly follow up with concrete and ambitious structural policies on Mario Draghi's proposals for enhancing European competitiveness and Enrico Letta's proposals for empowering the single market. We welcome the European Commission's assessment of governments' medium-term plans for fiscal and structural policies as part of the EU's revised economic governance framework. Governments should now focus on implementing their commitments under this framework fully and without delay. And this will help bring down budget deficits and debt ratios on a sustained basis, while prioritizing growth-enhancing reforms and investment. Turning now to inflation. Annual inflation increased to 2.3% in November, according to Eurostat's flash estimates, from 2% in October. The increase was expected and primarily reflected an energy-related upward base effect. Food price inflation edged down to 2.8% and services inflation to 3.9%. Goods inflation went up to 0.7%. Domestic inflation, which closely tracks services inflation, again eased somewhat in October, but at 4.2%, it remains high. This reflects strong wage pressures and the fact that some services prices are still adjusting with a delay to the past inflation surge. That said, underlying inflation is overall developing in line with a sustained return of inflation to target. The increase in compensation per employee moderated to 4.4% in the third quarter from 4.7% in the second. Amid stable productivity, this contributed to slower growth in unit labor costs. Staff expect labor costs to increase more slowly over the projection horizon as a result of lower wage growth and higher productivity growth. Moreover, profits should continue to partially offset the effects of higher labor costs on prices, especially in the near term. We expect inflation to fluctuate around its current level in the near term, as previous sharp falls in energy prices continue to drop out of the annual rates. It should then settle sustainably at around the 2% medium target. Easing labor cost pressures and the continuing impact of our past monetary policy tightening on consumer prices should help this process. Most measures of longer-term inflation expectations stand at around 2%, and market-based indicators of medium to longer-term inflation compensation have decreased measurably since the Governing Council October meeting. So let's look at the risk assessment. The risks to economic growth remain tilted to the downside. The risk of greater friction in global trade could weigh on euro area growth by dampening exports and weakening the global economy. Lower confidence could prevent consumption and investment from recovering as fast as expected. This could be amplified by geopolitical risks such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which could disrupt energy supplies and global trade. Growth could also be lower if the lagged effects of monetary policy tightening last longer than expected. It could be higher if easier financing conditions and falling inflation allow domestic consumption and investment to rebound faster. Inflation could turn out higher if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. By contrast, inflation may surprise on the downside if low confidence and concerns about geopolitical events prevent consumption and investment from recovering as fast as expected, if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Greater friction in global trade would make the euro area inflation outlook more uncertain. Financial and monetary conditions now. Market interest rates in the euro area have declined further since our October meeting, reflecting the perceived worsening of the economic outlook. Although financing conditions remain restrictive, our interest rate cuts are gradually making it less expensive for firms and households to borrow. The average interest rate on new loans to firms was 4.7% in October, more than half a percentage point below its peak a year earlier. The cost of issuing market-based debt has fallen by more than a percentage point since its peak. The average rate on new mortgages at 3.6% in October is about half a percentage point lower than its highest point in 2023, even though the average rate on the outstanding stock of mortgages is still set to rise. Bank lending to firms has gradually picked up from low levels and increased by 1.3% in October compared with a year earlier. Debt securities issued by firms were up 3.1% in annual terms, which was similar to the increase in the previous few months. Mortgage lending continued to rise gradually in October, with an annual growth rate of 0.8%. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks remain resilient, and there are few signs of financial market stress. Financial stability risks, nonetheless, remain elevated. Macroprudential policy remains the first line of defense against the buildup of financial vulnerabilities, enhancing resilience and preserving macroprudential space. So, in conclusion, the Governing Council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions. Thank you.
Thank you. And the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, I have two questions. Thanks, first of all, for taking them. The first is like on a general flavor of the arguments which have been exchanged in order to reach the decision today. So what were the key arguments in favor of that 25 basis point rate cut? Second question, you dropped the reference to need to keep interest rate restrictive or sufficiently restrictive for the foreseeable future. Does that also mean that you consider perhaps a larger rate cut at your next policy meeting, or is that something you have been discussing at least? Thank you.
Well, thank you very much for your two questions. We had a governing council meeting that was the last of 2024, and which really led us to acknowledge not yet the victory against inflation, not yet mission accomplished, but certainly it led us to acknowledge that inflation was really on track in terms of reaching our 2% target in the medium term. And, you know, that gave us a level of confidence to actually decide a cut and to decide the appropriate cut, which is, in our view, 25 basis points. That proposal was agreed by all members of the Governing Council. there were some discussions with some proposals to consider possibly 50 basis points, but the overall agreement to which everybody rallied was that 25 basis points was actually the right decision. And I think it was predicated on three key elements. The first element is that inflation in our projections has converged towards 2% for 6 projections exercises in a row. So you probably have forgotten, as I wish I had, the days when everybody was considering that maybe we would slip into 26 and we would not reach 2% in 25. Well, as I said, 6 times in a row, our projections are telling us that we will be at 2% target in the course of 25. And if anything, it has moved a little bit forward in the course of 25. But suffice to say that in 25, we shall be at 2%. And that is, clearly reflected in the projections that we have. I think the second element is that past shocks have pushed underlying inflation down. If I look, for instance, at wages, if I look at profits, and you remember the discussion that we had many times about the buffer that profits could exercise to absorb additional labor cost. Well, we are actually seeing that reality unfolding, and the projection for compensation, whether we look at the wage tracker, whether we look at compensation per employee, whether we look at the vacancy ratio, all of that is pointing in the direction of wages gradually in the course of 25 reaching a percentage increase that is compatible with our 2% target. And in terms of profits, we are also observing the same movement of profits having declined and being in a position to absorb some of these labor costs. Productivity, we are beginning to see also a little bit more promising numbers. So those 3 components, wages, profit, productivity, also heading in the right direction. And I think the third element that we took into consideration and that led us to this decision is that, risk to inflation is not two-sided, clearly. And that led us to, number one, making the decision that we've made, but also removing the reference to restrictiveness that you have mentioned. And by that, I'm also addressing your second question by the same token. But having said all that, we still have service inflation, which is running high. And if we look in particular at domestic inflation, we are still at 4.2%. And service inflation has hedged down a little bit from 4 to 3.9, but it is still resistant. And we would really want to see a change in the composition of inflation to feel totally confident that we are really almost at target. Thank you.
And the next question goes to Corentin Chaperon of Reuters here in the front row.
Thank you. Just a quick question, coming back to inflation. How do you see risks around the inflation target? Do you feel the risk of undershooting is higher than the risk of overshooting? And could you give us a sense of what those risks are?
The risk to inflation are clearly stated in our monetary policy statement. And as I have said, they are more two-sided than they were before. And that's really the analysis that we have about risk to inflation. That's how we look at it.
Thank you. And the next question goes to Jana Rando of Bloomberg. Jana, please.
Hello, good afternoon. Thanks for taking my questions. I'm wondering when you changed that language on the need for restrictive policies, you must have had a debate about the neutral rate in one way or another, and I'm just wondering if you can fill us in a little bit on that debate and maybe share how far you think and the Governing Council believes current policy settings are from those neutral levels. And the second question I have is that after what the market has heard so far, it is now pricing a larger 50 basis point cut for January. And I'm just wondering if, you have any thoughts on that. Thank you.
No, I don't really think about that. But I would simply observe that that was the case also a few weeks ago, and things change over the course of time, depending on data, depending on assessment of the situation. And this is exactly what we are going to do. We will continue to be data dependent. We will continue to decide meeting by meeting. We will continue to not have a pre-committed path downward. But it will be, again, based on the three criteria that we have flagged and that I have repeated at least 3 times in this monetary policy statement. I will not inflict a third repetition of that. That's what we will do. And we are not anticipating X or Y for the next monetary policy decision that we will take. A lot is going to be clarified, we hope, in the next few months, not in the next few weeks. If there is, one thing that we discussed in the last 2 days, it's the level of uncertainty that we are facing, and whether it's uncertainty resulting from political situations in some of the member states, whether it's uncertainty resulting from, excuse me, from the outcome in terms of policies of the US elections. All of that is largely a question mark, because there is a distance between the words and the action taken. I come to you with the neutral, but I just have a sip of water because my throat is not helping. So, neutral, what I would really recommend is that you go back to this publication that we had approximately 1 year ago, which really discusses the tools and the method that we all try to apply in order to determine something that cannot be determined with great precision, particularly in advance. And those methods, are based on either inflation, financing, savings, economies, and this is what is done by our staff very ably. But have we discussed the neutral rate in the last couple of days? No.
The next question goes to Aude Kersulek of BFM Business, French television. Thank you.
Thank you, Mrs. Lagarde, for taking my questions. What happens if the US sets up tariffs against Europe? Will the ECB react? And second question, inflation and core inflation in medium term will settle at around 2%, so this is your mandate. Do you think it's time now to focus on improving the domestic demand and growth that are both low, whereas the American economy is vigorous? Thank you.
Okay, thank you for your 2 questions. The first one about trade. I've given my views very extensively in a recent Financial Times interview. And I continue to think that restrictions on trade, protectionist measures are not conducive to growth and ultimately have an impact on inflation that is largely uncertain. In the short term, it's probably net inflationary, probable, but the overall impact on inflation is uncertain because it is going to depend on the scope of the measures, on the retaliation that is decided, on the rerouting of trade traffic from other parts of the world. And that is a very complex situation with movable parts, which we will determine if and when they come. On your second question, I'm tempted to suggest that you put it to somebody else, because, our focus is price stability. That is our mandate, and that's the best we can do to help economic actors to make their decisions and to create growth and create value. Everybody has to do their job. We have to provide price stability. Member states in Europe and in the euro area in particular have to comply and respect the governance, the fiscal governance framework that they have established for themselves. And that includes a combination of fiscal consolidation and growth-enhancing measures at the same time. And if other measures which are expected by the economic operators are delivered, then I don't see any reason why demand would not be stimulated as a result. But everybody has to do their job. The central bank cannot be the jack of all trades. We have to do our job, which is to procure price stability.
And the next question goes to Olaf Storbeck of the Financial Times. Olaf, please.
Thanks. I have also a question on this dropped reference to keeping policy rates sufficiently restrictive. This was seen as a kind of sign of the tightening bias by many people, I think also within the ECB. Dropping this reference, does it mean you now have an easing bias, or would that be pushing it too far? It would be interesting to get your thoughts on that. And my second question would be on the staff projections. I think in September, the minutes showed that when the projections were presented, there was already a concern that they might be too optimistic because of kind of things that had happened between the cutoff and the meeting. Has this been the case again this time? And did you discuss how to respond to kind of in a scenario that those projections turn out to be too optimistic? Thanks.
On your first question about restrictiveness, we are currently restrictive. And it's stated very clearly in the monetary policy statement in the 4th paragraph, if I recall, where we say very clearly that, I want to give you the exact reference so that we don't make any mistake. It is in the 4th paragraph. We talk about the financing conditions, and we say, but they continue to be tight because our monetary policy remains restrictive. So we are currently restrictive. There is no questioning in that respect. And the direction of travel currently is very clear. The pace at which it happens, the data that will determine it, the method that we will apply, the meeting by meeting, all of that is quite clear. But, obviously, a lot of ground has been covered. We have already cut interest rates 4 times, total of 100 basis points. We are now, as a result of this decision today, at 3% for the DFR. And we are in a completely different environment. We are getting much closer to target. As I said earlier, our projections for 6 times in a row indicate convergence towards 2% in 2025. We see two-sided risk to inflation. So the macroeconomic landscape in which we make our decisions is vastly different from the days when we were at very high inflation, we had a lot of ground to cover, and risk to inflation was one-sided. So as a result of that, it was completely legitimate and natural to remove that reference to being restrictive for long enough to arrive at a target in a timely manner. That is the other word, which, as you may have noticed, has disappeared from our monetary policy statement, timely. Now, you asked me about...
And now, as Christine Lagarde, the president of the ECB, addressing the questions from journalists on the day that the ECB has decided to cut rates once again by 25 basis points. At the moment, though, when you think about some of the comments from the ECB president, she said that they consider the possibility of 50 basis points. They did discuss that potential cut, but everyone rallied behind the 25 basis point cut, which indeed was the final decision. She also made a comment on trade risks and whether that could be a potential risk for the Eurozone. She also said the risk of greater friction in global trade could weigh on Euro area growth. And speaking of that, we're keeping a close eye on what's happening in New York today. Donald Trump has been mentioned by Time magazine as Person of the Year. He's at the moment at the New York Stock Exchange, where he is expected to be ringing the bell shortly, marking the start of the trading day on Wall Street. So we'll leave it there on this note. We'll hand you back to our colleagues stateside.